All right, why don't we go ahead and get started? So my name is Mark LaMonica. I am, I am the product manager for Morningstar Premium, morningstar.com.au. And today we're going to talk about how to value a share. First, we'll do our housekeeping items. So a couple things. Number one, we're not doing one on Thursday. So Will and I both have, I guess, the day off for different reasons. Will's working, but he's got to fly up to Brizzy. But yeah, anyway, so we won't do it on Thursday. We will publish a new list of upcoming webinars. Hopefully tonight I'll do that. And then we'll send out a registration email next week. The other thing is, of course, anything you hear today is general advice. So I don't know anything about your personal situation. If you are from New Zealand, you can go and read our FAP, which is found on morningstar.com.au. And the New Zealand regulatory authorities would like you to know that you should consult with a financial advisor if you have specific questions related to your particular circumstances. The other thing is I would like questions. So there's a Q&A button on the bottom of the Zoom screen. So ask any questions that you have, send them through in the chat. And yeah, hopefully today is a decent session. So we're going to do a couple different things today. We're going to start by talking a little bit about relative valuation techniques, which we'll get into what that means. Then we're going to go through a discounted cash flow model, which is how most people value shares, business opportunities, anything else. We'll go into a spreadsheet. Hopefully it will be somewhat fun. And yeah, that's the approach we are going to take today. So this is off the back of, I don't remember maybe last week, where we talked a lot about what makes a company great. We talked around how to pick investments. So talked about what makes a company great. So we looked at sustainable competitive advantage or moat, went through some of those different moat categories that we have for ranking companies. And this is sort of the offshoot on that, right? So we talked about buying a great company, which is part of what we think makes a great investment. But the other side of things is, of course, buying something at a compelling price. And we've heard a lot, and particularly if you've listened to these things with me, we've heard a lot about valuation levels in the market. And it's really, really important to look at what happens when you buy stuff that is too expensive. So that's why we want to talk about valuing a share. And hopefully today, even if you're not going to build your own discounted cash flow models, hopefully if you understand a little bit what goes into them, that can help you think about evaluating companies, even if you're letting professionals do that, whether that's a Morningstar analyst or whether you are working with a financial advisor. So that was our long intro. Let's find the PowerPoint. Okay, here we go. That's it, how to value shares. So that's my name. So if you have any questions, you can email me at mark.lamonica1@morningstar.com, and I will get back to you. All right, so let's start with relative valuation techniques. So obviously people can read this. We'll go through each part of it. One of the important things about a relative valuation technique, like a price to earnings ratio, is that you remember that this is not valuing anything. So looking at a ratio does not value something. Looking at a ratio, and why this is a relative valuation technique, is it's because it allows you to compare things. So you can answer questions, what is more expensive or less expensive, but what that doesn't allow you to do is say does either one of those make sense from a valuation perspective. Okay, I'll answer your question in 1 second. An early question, but I will get to that one. All right, so let's start going through these. I'm flying solo today. I don't have anyone helping me answer questions. But that's okay. All right, so relative valuation technique involve comparing standardized metrics. So let's talk about a standardized metric. So obviously, if we want to compare two things, we need to make sure that what we're comparing actually makes sense. So examples of standardized metrics are, and I've seen this a lot lately. So I wrote this piece today on the website. It's part of a 3-part piece on my journey through Bubbleville. I've seen a bunch of stuff in these Reddit boards and Facebook boards that is just so wrong. So one of the very important things to remember when you're looking at share prices, the actual price of the share does not matter. I've literally seen these posts where people are saying, oh, I should buy Zip instead of Afterpay because Zip is cheaper. Just looking at the share price doesn't tell you anything. So something's $10 or something's $100. None of that matters. What matters as investors is what are we actually getting for that? And what we're getting is a share of a company. So we need to look at however we want to measure that company, whether it's the revenue they make, whether it's the earnings, whether we're back in .com bubbleville where we're looking at clicks. All of that needs to be standardized. So that is why, for instance, we use a lot of earnings-based measures, and we compare them to price-based measures. So that's why you got to do a little division, right? So price to earnings is an example of a standardized metric. The earnings by itself, of course, does not matter. What matters is how much you're paying for those earnings. So whether we're looking at the price of the share, whether we're looking at the overall earnings level, none of that matters unless we standardize it and put those two things together. So price to earnings, price to cash flow, price to book. All that is doing is standardizing different companies that are trading at different share prices to make sure as investors we understand what we're getting. So in that case, in price to earnings, it is what are we paying for earnings? So for $1 of earnings, what are we paying? So very simple, price to earnings ratio of 10 means that as investors, we are paying $10 for every $1 of earnings. All right, so that's the standardized metrics piece. Then we want to look at peer groups. All right, so peer groups are important because remember the whole reason that we are doing a relative valuation technique is because we want to compare two things. And we can compare companies, right? So that's fine. We can compare a company to a sector. We can compare a company to the overall market. We can compare historical numbers. A company used to be trading at a PE for 10, now it's trading at a PE of 20. We can look at markets historically. When we say the market seems expensive, what are we doing? We are comparing the market to what it used to trade at. Market used to trade at a PE of 20, now it's at 40. So that's really important, those peer groups that you're comparing. And we'll get into another reason why that's really important in a second. But then finally, this last part, perceived to have value from investors and therefore drive future investment returns. So this is the whole problem we sometimes run into with metrics is that people, or relative valuation techniques, people use them to justify things. I made the joke about .com, the .com bubble where we heard all sorts of stuff. We said that when we were valuing internet companies, we were paying for eyeballs and clicks and impressions and all this stuff. But at the end of the day, none of that mattered because what we're really paying for, and we'll get into that, we'll get into this discounted cash flow, we're paying for earnings and cash flow as investors, right? Just like if I went and bought any sort of company, if I went and bought my corner store, I am paying for the earnings that are generated in the future. And we'll get to that future part in a second. But it's important to make sure that over the long term, whatever this perception is of value, and ultimately what it's going to be is earnings and cash flow, we need to make sure other investors want the same thing. All right, so let's talk about some of the problems with relative valuation techniques. Well, one of the big problems is with all of them is that, and we'll get to a caveat in a second, but they are mostly all historic looking. And, that's fine, right? But as investors, what are we looking to buy? We're looking to buy companies for their future cash flows and earnings. So that's one of the huge problems that you run into. So anything that you hear, price to earnings, that is looking at historic earnings. It's looking at earnings that have been published by the company. They have been audited and put out in financial statements. So that's a huge problem we have with relative valuation techniques. That's not actually where the value of the company is coming from. So there's this quote by Bill Miller. He was a pretty famous value, well, he's still alive. He was a famous value investor who had this long streak of beating the S&P 500 that then he pretty spectacularly did not beat it. But anyway, it's a good quote where he says all the information we have about companies is in the past and all of the value is in the future. So that's one of the problems with these relative valuation techniques. The other big problem, the caveat to that is you do have relative valuation techniques that are based on future estimates of earnings, for example. So you'll see that they'll say forward. So that would be a forward price to earnings ratio. What that means is that the company's not earned that money yet. Somebody, and generally it's like a consensus of analysts, has estimated what they're going to make next year, and then you see that forward PE. So if you have a really fast-growing company, you're looking at the actual PE, so what they actually earned versus what they're going to earn in the future. That can make a very big difference. So you will see some of those forward PEs. But once again, we'll get into this when we do the discounted cash flow model. That is the future, right? So it is somebody that is predicting the future. So that's another issue that we run into with these things. The biggest issue, I think, that we run into PE ratios, for example, or any of these relative valuation techniques, is they are sold to investors as a shortcut. So it's easy. All you have to do is, most websites, including ours, publish them, but all you have to do is divide two things together, two things that are readily available, right? I can go to the financial statements, find out how much a company earned. I can divide that by the price just by going to get a quote. It's easy. Anyone can do it. But the problem is that you still have to interpret them, because even when we're looking at relative valuation techniques, they are not apples to apples comparisons, right? So we'll use a couple examples. Let's start with companies. So if I look at two companies, they are in the same industry, and we'll get to different industries. They're in the exact same industry. I'm looking at two companies, they do the same thing. It's Coke and Pepsi. So they're kind of doing the same thing. I know Pepsi's a different company and lots of snacks and everything else, but bear with me for my example. They're doing the exact same thing. So as an investor, should I just look at the PE ratio and buy the cheapest company? Well, no, because I have to understand why they are trading at different levels. There could be all sorts of different things about these companies. One could be growing a lot faster. If something's growing a lot faster, investors are going to pay more money for it. If they think it's going to grow a lot faster. One could be very, very safe, have lots of cash, very little debt. One could be highly leveraged. So there's all these different factors that you need to look at with companies when you're doing this. And the problem is that when people think this is a shortcut, it's not. You actually have to do almost the same amount of analysis as you would do if you're doing like a discounted cash flow, for example. So that's a company example. The other example is people often compare Ps from different industries or sectors. And that can be a huge problem too, because different sectors have different characteristics, whether that's debt levels that they're taking on, so basically leverage that companies will have, very different growth rates, different ways that they make money, right? So there can be, you could be an oil and gas company that needs huge capital investments to go out there and find oil and then drill for it and then transport it, versus an internet company where, yeah, the thing is almost infinitely scalable. You don't have to go out and hire a bunch of people. You don't have to go out there and build all this infrastructure, all these tangible assets, property, plant, and equipment in order to make money. So that's probably the biggest. That's a good question. That's probably the biggest difference between, or biggest problem with PEs, that you cannot just look at them in isolation. You do need to actually do an analysis of the company. What you can do, perhaps, is look at things on an aggregate level. So certainly a lot of these quant investors that are going through and having portfolios of 300-400 stocks and are just tweaking little factors in there to find companies. That's one way to do it, because you're basically diversifying out you knowing anything about the company. But if you're going out there and just picking a couple stocks for your portfolio, you need to go beyond these relative valuation techniques. All right, so this was just how I was supposed to explain it. I did my fancy highlighting different things. All right, let's get into what we're really talking about today, a discounted cash flow model, or a DCF model. And what this is you can read, is we are now going to value a company using cash flows that the company generates. So we are going to forecast them into the future, and then we are going to discount the cash flows back to the present day and come up with a value. So it seems simple, right? But let's go to a spreadsheet, and we'll try our best to do this. All right, so we need a couple inputs into this. And this is where yes, this is hard to do, come up with some of these impacts. This model is very simple, and I've obviously simplified this, but it's just math, right? So it makes us think that there's a lot of precision, but the difficulty that you run into is obviously making all these estimates. So let's talk about what we're going to do. All right, we're going to use free cash flow. Now, free cash flow, we can use any sort of measure for this. So people do this with earnings. People do this with, there's a dividend discount model where people do this with dividends. But we're going to use free cash flow. And what free cash flow is, we're looking at the difference between earnings and cash flow. So earnings, of course, are an accounting measure. So there are accounting rules that determine what goes into earnings. Free cash flow basically is all the cash that a company will generate after you account for cash outflows to support current operations, we'll get into what this means, and maintenance of capital assets. All right, so let's break this down a little bit, talk about these differences. So earnings. Earnings, as I said, are an accounting measure, which means that there are non-cash charges that come out of earnings. So there are costs that are in earnings that are non-cash. And there's also some different ways that you recognize revenue, so revenue recognition that may not necessarily correspond with cash flows. So a simple example is, a good example from Morningstar. So we sell Morningstar Premium, a subscription-based service. So you pay for your year of premium before you actually use the product. So if you go in the first day and you pay your subscription fee, Morningstar gets that money in cash. Now, that does not flow to earnings immediately because the product we sold gets delivered over, if you sign up for a 1-year subscription, over 12 months. So basically it's just accrual accounting. And we'll get into these different parts of accrual accounting, but that money that comes in, if it's called $120, so we can do the math easily, $120 comes in, $10 a month gets allocated into actual revenue. That's a difference between mistiming on revenue. The other big mistiming that you get is these non-cash charges. So depreciation is a big one. Amortization is another one. So we'll just use depreciation as an example. Depreciation is simply the fact that you are depreciating capital assets over time. And that is not an actual cash charge to a company. So the example that I always use, because I think it's good, but I should come up with a new one. The example I always use is Qantas. So Qantas decides that they want to open a new route to New Zealand because now everyone's going to go to New Zealand. So they go out there and they buy a plane. And let's say the plane costs $100 million. So they go out there and pay cash or finance this plane. So let's just make it simple. Let's say they get $100 million, they give it to Boeing, they get a new plane. This plane is going to last for 10 years. So in year 1, they're spending $100 million on the plane. In year 2, they're spending nothing on the plane. They're not going out and buying a new plane, but you're going to depreciate that $100 million asset. The plane's an asset, something that they own, sits on their balance sheet. You depreciate that over 10 years. So in this example, $100 million, 10 years useful life. Every year, $10 million charge hits Qantas's earnings. Now, some people will argue that that is real, because at the end of 10 years, Qantas needs to go buy another plane. They're an airline, they need planes. Some people will say, well, no, it's a non-cash hit to earnings. So there's all these kind of academic arguments about what you're going to do. Amortization is the same thing. It's just non-tangible assets, where a plane is a tangible asset. So think like goodwill, something if you buy a company, things like that. So we use the simple one. Anyway, the point of this whole thing is that free cash flow is trying to take all of these earnings, non-cash charges out. So we'll go back to that definition of free cash flow. So we are all the money that the company generates, all the cash that comes in, if we're using Qantas as an example, all the tickets that people buy and drinks on the plane and everything else, all the cash that comes in. Then what we take out is cash flows to support operations. So that's anything to support what they're doing. They got to pay the pilots. They got to fill the plane up with petrol. They need to pay everyone else, buy some peanuts, things like that. So all the stuff to run the business, all the cash outflows that support that. And then cash to maintain capital assets. So in this case, it is, you got to do some maintenance on the plane. All right, so I don't know, it flies for 3-4 months and we got to put it up in the hangar and you've got a bunch of engineers working on it, maybe replacing some parts. All of that is free cash flow. What's not, all of that comes out of free cash flow. What does not come out of free cash flow is capital expenditures. So going and buying a new plane, for example, would not be included in free cash flow. So that's the measure we're going to use. It's the measure we use at Morningstar, but there are different arguments about what measures you're going to use. But either way, you're projecting something out in the future. So what do we need? We need the free cash flow growth rate. So in order to project this out in the future, we need to come up with, and I've used a steady rate in here, I've used 5%. We need to figure out how we're actually going to do this in the future. So what our analysts do is they are looking at the company, they're looking at what the company's doing, they're looking at competitors, they're looking at general economy, and all of this stuff is forecast. And they're literally building out these financial statements 10 years into the future. All right, we'll get to the 10 years in a second. The other thing we need, well, we'll get to the other inputs. So let's start in the beginning. So what our analysts are doing, and I did a very, very simple model here, but they're trying to calculate at the end of the day is free cash flow. Now, they're going to estimate this out 10 years into the future. Now, that is not universal. So a lot of people will argue 5 years, and there's lots of different arguments each way. But basically what you want to do, because you need to build out accuracy, as much accuracy and detail as possible into this, you can't forecast too far out in the future because then you're just guessing. So it's really sitting there and figuring out, okay, what am I comfortable estimating? And we use 10 years. A lot of people use 5 years, but we'll get to what happens after that. So all I've done here in this model, so I've got a year one, and then I'm just projecting this out in the future. So you see, I'm basically looking at C2 right here. If you see the formula up there, 1 plus C2, so that is that times 1.05%, and we're estimating this out 5% growth each of the next 10 years. All right, so that's the first part. Now, remember, this is a discounted cash flow model. So what we've done is we've estimated the cash flows, which is great. Here you have them. Now we have to get to the discounting part. And this is a very important concept in investing and finance in general, that $1 today is worth more than $1 in the future. And what does that mean? It means future dollars need to be discounted. So hopefully that makes sense, that if something is not worth as much in the future, we need to discount it. Now, what we use, and once again, there's different discount rates you can use. What we use is something called the WACC, the weighted average cost of capital. So what the weighted average cost of capital looks at is it looks at, for a company, where do they get their capital from to fund the business? So basically your choices are, at a high level, debt and equity, right? 2 ways that I can fund my company. I can go out there and borrow money. So I could borrow money from a bank. I could borrow money by issuing bonds, hybrids. There's all sorts of different debt that I can use. I can also go out and I can fund it with a cost of equity. I can fund it with equity. I can issue more shares. We saw a lot of companies do that in 2020 when the COVID restrictions started. They were going out there and they're doing secondary equity offerings. So these are already publicly traded companies because they wanted to raise cash to get through whatever these COVID-related disruptions were going to be. So that's the other way I can raise capital. So basically, at the end of the day, what we're looking at for WACC is we are looking at what is the cost of debt. Now, the cost of debt for a company is almost always discoverable as long as they have debt, because basically bonds will adjust in price based on credit quality of the company, based on the level of interest rates. So I can always go out there and look at the cost of debt. So it's pretty easy to figure out. Cost of equity is a little trickier, and I'll do a sort of brief overview. A lot of people look at something called the capital asset pricing model to look at the cost of equity. We just assign different costs of equity based on how risky we think the company is. So that's what we do at Morningstar. We blend those two things together based on the capital structure of the company, how much debt they have versus how much equity, and all of a sudden you have a weighted average cost of capital. Okay, so that was probably very confusing, but simplified, What that means is a lot of people will use either, number one, they'll use their required rate of return in this calculation when they're looking at stocks. I need to make 8% a year, so I'm going to use that as the discount that I'm going to bring this back. People will use a risk-free rate plus. So they'll sit there and say, what's the risk-free rate, which is basically 10-year US Treasuries, and they'll add something on top of that. So I want to do risk-free rate plus 5. Either way, you need to discount back these cash flows with something. Now, we'll get in the end why this number matters and why equity markets go up from a valuation perspective when interest rates go down, because it's an input into there. But we'll get into that in a second. We need debt and cash and shares outstanding. We'll get to why we need those in a second. But what we've done is we've just simply discounted back each one of these future cash flows. We've discounted them back to the present value. Now, I just lined them all up here so you can see it. So this $253,000 that we make 10 years from now is worth $97,000 today, given the discount rate I'm using. And we simply come up with the sum. We've add up all these present values. So there we have it, 1.2 million. Now, that's not what the company's worth, because we've only gone out 10 years. So the interesting thing about companies is we have to assume that a company is going to be operating in perpetuity, right? There's lots of things that can happen to a company. They can be bought, they can go out of business, all sorts of things can happen, but a company can also last forever. So we have to assume perpetuity, and we're only valuing 10 years of this company. So what do we need to look at? We need to look at something called a terminal value. And as I said before, we can't sit there with any sort of accuracy and say that we are just going to predict what this company is going to make for the next 100 years. So we need a terminal value. So what is attached to a discounted cash flow model is something called the long-term growth rate. And that is the assumption. We assume that the company will grow with that value in perpetuity forever. So a lot of people will pick like a GDP estimate. So how much we think the overall economy will grow, thinking maybe this company can just grow with the overall economy. It's not growing faster. It's not growing slower. That's just a good average. But either way, we need a number. So I use 2%. So that's what we think is going to grow on average every year after that. So 2%, we've got the free cash flow in year 11. So all I've done is I've taken this year 10. I have gone up 5% from that. I have not gone up 5%. I've gone up 2% on that. So we've got free cash flow in year 11. And we can calculate that terminal value just by dividing. So if you look at the formula, we've got that free cash flow in year 11. We are now dividing that weighted average cost of capital, that 10%, or we're taking 10%, we're taking 2% from 10%, then dividing it by that 8. And that's just a simple way that we can calculate what that terminal value is worth. Then, of course, this is the value in year 10. We discount it back to the present by looking at that weighted average cost of capital again. All right, easy, right? We're almost done. I'm sorry. I know this is, even I bore myself with this. So what we've done is we've added up these two different values, the terminal value and the sum of the present value. So here we go, $2.4 million roughly. We're almost done. We're really, really close. We need to look at debt and cash that the company has. So what we're going to do is we are going to subtract the debt, because I'm an equity holder. So I don't get access to that. We need to subtract the debt and add back in the cash. We get a number. We divide it by the shares outstanding. We get a value per share. All right, we did it. So sorry, I know that was overly complex and probably pretty boring, but that is how you do a discounted cash flow model. Now, a couple things we should think about. So number one, this value seems very precise. And this spreadsheet, this is math, right? So seems very precise, but that precision is not actually true because I have put a bunch of estimates into this. So anytime that you are predicting the future, obviously the future is unknowable. So I put a bunch of different estimates in this. So the old saying, garbage in, garbage out, with a model, That is this. So what matters are those estimates. That's why as investors, we always want to take a margin of safety when we are investing in a company, because we know that nobody can predict the future. No matter how smart analysts are, they're not going to nail this to the cent or anywhere close. So that's why we need an adequate margin of safety to account for this imprecision and the fact that the future is unknowable. So that does not mean that you should go out there and buy the share if it's trading at $22.60 and you're like, wow, I've got this great deal. It's worth 5 cents more. So be careful about the precision. Remember that what goes in matters. So what I did is I ran through a couple scenarios where I changed some of these inputs. So let's start on the first one. And this will just show you, and this as an investor I think is important so that you understand how when different things change, you see share prices change. And we'll start with the weighted average cost of capital. All right, so if I reduce that by 1%, so if I go from 10% to 9%, so very simply, I can go up there and adjust this. So if I go to 9%, yeah, this thing has changed to 26.38. Now it threw off all my formulas, so I'm gonna go up there and change it again. But that's basically what I did. So if I reduce that by 1%, the share value goes up to $26.38 compared to this $22.65. So that 1% reduction in weighted average cost of capital means the share price went up 16%. Why is that? The reason that that's happening is because we are discounting future cash flows by less. So if the discount is smaller, it is worth more. Future cash flows are worth more, which means the company is worth more. That is why when interest rates go down, that's why the value of shares go up. And that's a huge problem also with these relative valuation techniques, right? That even if we're comparing the market overall, we're comparing markets that have different interest rate levels. So we don't actually know what the market's ever worth, and we would have to take those into account when we're looking at relative valuation. So anyway, you reduce interest rates, the market is worth more. If you raise interest rates, the market is worth less. That's why the market freaks out when interest rates go up. So, all right, we had that little burst in February where, I don't know, it was 20, 30 basis points, not even, so they're 100 basis points and 1%. The market freaked out. So be careful about that. So if you look at the situation we're in now, the market has forecast interest rates being very low for very long. If something changes and interest rates go up, the market's going to go down a lot. So something to think about what's actually priced into the market. And when we say priced into the market, it means all these analysts that have all of these discounted cash flow models, what their assumptions are. When their assumptions change, their valuations change. So that's why there can be issues. All right. 1% increase in free cash flow growth for 10 years. So we're looking at that 10-year growth rate. I'm raising it 1%. So we had it at what? We had it at 5. I raised it up to 6. So that's a 7% increase in the price of the share, the value of the share. Now, the thing that's important to look at here, and same thing with terminal growth. I up terminal growth by 1% because this is over perpetuity. We get an even bigger pop. So one thing to think about this, and you see this all the time as investors, and I remember when I was young and I didn't understand this stuff, I saw that a company would report earnings and they looked great. So they beat whatever the estimate was for their current earnings. Everything looked awesome and the stock price would go down. I could never figure that out. I thought, well, this is a really good thing. Like they've reported earnings that are higher than what the estimates were. But they said something in there, or they changed their future forecast that freaked the market out. So analysts, I'll stop saying freaked the market out. So analysts went in there and of course they changed all their models and were like, well, this is worth a lot less, because what matters is what's in the future. So as soon as companies report earnings, they're in the past. And what analysts and investors do is they use those earnings statements to go back and revisit their model and their forecast. So it's the future that always matters. So just remember that. And then I did this during COVID. So I did this for the first time geez, it was probably around this time last year, or maybe in March. I don't know. It's all blurring together. But people were obviously very worried about what the impacts were going to be of COVID. So I just wanted to show people that what happens if I zero out free cash flow in year one. So the premise here was that you're a company and you make no free cash flow in the next year because there's all these COVID restrictions. Everyone's locked in the house. I was just showing that if things got back to normal after that year, there's still a lot of value in this company, right? So yeah, we did have a drop in the valuation levels in this example, but at the same time, if things get back to normal and the company starts making money again, there's a lot of value in the future. And I was comparing this 6.5% reduction to think about the markets when they're in sort of free fall and they went down 30% or something in 3 weeks. I was trying to show people that, hey, this could be an overreaction as long as we get back to a spot where companies are operating again. All right, that is fun with spreadsheets. So hopefully that was somewhat helpful. We've got some questions now. All right, so the anonymous attendee, who I always say is our favorite attendee because they are anonymous, says, does inflation impact valuation methods, and if so, how? Okay, so let's look at inflation. Let's break inflation down to a couple different components. Let's say inflation was somehow, well, this is a stupid exercise. All right, the problem with inflation is that if you are a company, inflation, as long as you can pass along those prices, so even if your inputs are going up, so let's say inflation is, we'll pick a number, 5%. So inflation's 5%, but inflation is perfectly aligned across the whole economy. So your raw material goods and your salaries and everything else go up 5%, but you raise all your prices 5%. There's no difference in demand because everyone in the whole economy is making 5% more money, so they don't care. Then if you're a company, fine. It wouldn't really impact this model. But the big problem with inflation is, number one, it doesn't work that way. It's not even. It doesn't evenly affect everyone. It does have a lot of changes on spending and saving patterns and everything else. And the other huge issue with inflation is likely to, at a certain point, lead to central banks changing interest rates. Now, a lot of the central banks have come out and they said they're not raising them no matter what. We'll see. So we'll see if inflation does pick up. And a lot of them have moved, of course, the range of inflation that they're willing to officially tolerate. But yeah, we'll see what happens. So that is why I think the market gets very nervous about inflation. So along with interest rates, which I talked about before, the market is also priced in really long-term low inflation. So if that changed and started ticking up, the market would get nervous. Even if central banks did not actually raise interest rates, the market would get really nervous that they were going to, and that this trend in inflation, if it starts ticking up, would continue, and it would force people to raise interest rates. So that's the problem with inflation. And once again, all this is just the market pricing things in. So just like that model, and remember, the market's a collection of obviously millions and millions of investors, from very sophisticated to I'm going and buying whatever they tell me on Reddit. But either way, the market has expectations that are built in there. And in this stupid article I wrote today, or maybe it's the one that's getting published tomorrow, I don't know, it's this 3-part series. It's something. I talked about expectations and talked about how I was worried that a lot of younger investors who are getting a lot of their investing knowledge from Facebook and Instagram, I've just seen all these ridiculous expectations that have been baked into people's heads. Basically that, market's going to return 12% a year if you have a diversified portfolio. Like, this stuff isn't going to happen long term. So all investors, no matter how sophisticated or unsophisticated are, you have expectations. And when expectations are not met, the market gets very upset. So if we sit there and we look at that model that I put together, yeah, analysts have expectations of what's going to happen. When things change from those expectations, they're going to change their models. They're going to change their valuations. When the market does not return 12% a year, somebody's going to figure out, wow, maybe I shouldn't have listened to this random person on Instagram and looked at, history or valuation levels. So yeah, that's my little rant. You can go to our website if you want to read my 3-part, written rant. Okay, so we've got a good question from Wayne. So Wayne said you mentioned this was a simplified example of the model. Where could you find what other inputs should be included? Okay, so basically, let me share my screen. That's a good question, Wayne. So basically, what our analysts do is they literally rebuild the financial statements. No, I can't do that. I was reading an article on basketball. Be proud of me, Will. I grew up outside of New York, so I'm a Knicks fan. They've been horrible for so long, but they seem like they're, turning the corner. Will even agrees with me. And so there's an article about how people in New York are actually starting to get excited about the Knicks. I'm finding something to share, by the way. This is not my thoughts on the Knicks. Will would be much better placed for that. Okay, so let's see. Gotten off this article. All right, so if we talk about some of the inputs, so I went to CBA, so Nathan's our analyst that covers CBA here. So literally what our analysts are doing is they're rebuilding the full financial statements of a company. So the income statement, cash flow statements, balance sheets of companies 10 years into the future. So if you go into forecasts, if you look up any Australian share, we don't have this for our global shares yet. If you look up any Australian share, you can see some of the things that come out of these inputs. So basically, this stuff with the A's, A is actual, E is estimates. Now, we only show 2 years on here, but you can see everything that they built out. So the earnings per share, free cash flow per share, book value per share. So that means you have to build out the balance sheet for that. The dividend paid per share, the payout rate. So based on what they're paying dividends versus what they're earning. Franking credits, because everyone loves franking credits. That's basically what our analysts are doing. So their models look very complicated. They look like literally the financial statements of a company. So go look up a financial statement of a company and you can see what they have. So good question. All right. So Lisa is of Alpaca fame. I've been hearing some things, Lisa. Here, you went to another webinar today. She's cheating on us, Will. What do you think? She went to Gareth's webinar. I mean, it cannot be as entertaining as this. Will's shaking his head. So Lisa says, I just watched the docudrama, The Big Short. That's a good description of it. About market events leading to the GFC. Are the actions of a few still able to affect the lives of many? Or has the global market been more highly regulated since the GFC? Yeah, I mean, it's a good question. I mean, I think, listen, banks are a lot more regulated than they were in the GFC. So certainly a lot of the stress tests that now central banks are doing on banks and the capital requirements of what banks have to hold, all of that has increased significantly. I think banks are a lot safer, certainly than they were back then. The only thing I would question is, like, with all of this stuff is, to use a war analogy, everyone's always fighting the last war. Right? So that's kind of the problem, that you could probably sit there before the GFC, and of course, everyone came out and said the banks are fine, they can absorb losses, it's not a big deal, because all of the regulation and everything else, and all of the people that are going in there and regulating the banks and inspecting them are all thinking of the last crisis, because the next one hasn't happened yet, right? So it was, if you look at the whole premise of what the banks did during the GFC, and I think it's simplistic to say it was a bunch of evil people. Basically, every single model said that you would never have a nationwide downturn in housing in the US. Every other housing downturn was regional. And so if the banks were diversified in where they were doing their lending and where this collateral was, everything would be fine, right? But that didn't happen. So all I would say is that, yeah, I mean, if I could predict whatever was going to happen, then once again, I'd be on my boat. So that's the only thing. That's the only thing I would worry about, Lisa. Yeah, I think the financial. I don't think that something's going to happen personally to banks right now. I think banks are pretty safe. I think especially in Australia, they're pretty safe. But doesn't mean this is not happening somewhere else. All right. So another question from Lisa. Lisa, you're on a roll. Do central banks still have as much influence over interest rates? Yeah, I would say the central banks are doing a lot more in order to maintain that influence. So a lot of the stuff they're doing around like quantitative easing, they're basically going out there I'll go very quickly because I know I've said this before. Yeah, what banks used to do is they used to buy government bonds, and that's how they buy or sell government bonds, short-term government bonds, and that's how they would control the discount rate. And that's really how they controlled interest rate, these open market activities. Then they started getting into, after the GFC, quantitative easing, where they're going out there and buying longer-term government bonds. Then with COVID, they started going out there and buying things like corporate bonds. They even bought in the US briefly, they bought bond ETFs as a quick way to get money into the bond market. Now, they were trying to do something very specific and making sure we didn't have all these zombie companies that went out of business during a pause in activity during COVID. So they were trying to do something very specific. But all I would say is, Lisa, is the banks or the central banks are doing more and more to control overall interest rates in different parts of the economy. So yeah, I don't know if they're going to lose control at some point, but seems to be working okay right now. Saban. So we have a question from Saban. Saban is my favorite college football coach. I'm a Crimson Tide fan, if anyone knows what that means. All right. How is valuation of shares affected by exchange rate fluctuations? Analysts believe that the US dollar will fall. What would be the impact on valuations? Okay. So two different things with this. So number one, there is, of course, well, let's talk about how most companies actually operate. A lot of companies that have big overseas operations, they're not actually bringing the cash back. And there's a lot of reasons they don't bring the cash back, namely tax issues and things like that. So in reality, if a company has operations, if an Australian company has operations in the US and they're keeping everything else in US dollars, and then they're investing those US dollars in the US to try to grow that part of the business, like maybe interest rates affect them. Well, maybe they don't, exchange rates don't affect them as much. But when we're starting to look at investing, why exchange rates really matter is because if you are an Australian investor sitting in Australia and you invest in a company, if you invest in CSL that has big operations in the US, depending upon where the US dollar moves compared to the Australian dollar, it's going to make cash flows and income and earnings and everything else by the company look a lot different because you're translating back everything into your local financial statements. So yeah, that could really matter. So you do need to have estimates, of course, as an analyst of where exchange rates are going to go. The other thing, which complicates things, the other thing that obviously matters is if you are a company, so I was just describing sort of the self-sufficient commercial operation in another country, you could very easily be buying or selling something that's priced in a different currency if your raw material came from somewhere else. So then it could really matter for you. All right, the anonymous attendee, does Australian Premium give access to research on American companies? Yes, it does. So, I'll put on my salesman hat for a second. Yeah, I don't know the best way to do it. So basically, what we provide is we provide all of our global research. I go to security type, and I go into equities. So, well, I'll show you an easier way to do this. If I want to create a filter on stocks. So we provide research on 1,600 global companies. So we've just spread them out across different continents. But yeah, you get all of our North American coverage, so mostly US, a couple Canadian stocks, our Asia coverage, and our Europe coverage. If you want to see the countries where we have coverage, so we have a team of analysts in Asia, in North America, and then in Europe. So if you go into our monitor markets, this is probably the easiest way to do it. So you see we have all these different countries. You're familiar with these two. Asia, you can see the coverage of all these. Simply clicking on one of these countries' names take you to all the countries that we cover. Europe's more interesting because we've got a lot of them. So like UK, if I want to see what we cover in the UK, I simply click on UK or any of those other countries, and you'll see everything that we cover. So we cover 73 UK companies that you get access to. So yes, you do get access to everything. All right, so we've got a question from another anonymous attendee saying, are different methods used for different sectors of the market, such as junior mining exploration companies? Yeah, so listen, obviously, if you are an analyst looking at different sectors, there are very specific things in sectors that are going to matter about cash flow. So like I showed you Nathan. So Nathan's job's pretty hard. Banks are notoriously complex to try to figure out. So that's an example where it's very different. If you are a mining analyst, for example, particularly if you're looking at a small, as you said, a junior mining exploration company, you're going to be very, very concerned with when cash flow starts. Right? It's one of the problems with mines. So you go out there, you buy some land, all of a sudden, well, you find whatever you're looking for, you acquire rights to actually mine there, and then all of a sudden you have to pour a bunch of capital into that spot of land to actually pull something out of the ground, right? So it's very expensive. It's very expensive up front. So you need to start worrying about things like when we get this out of, when are we going to find this? When are we going to get it out of the ground? What is the price it's going to be once we get there? Because a lot of these junior mining companies, the problem is it's sort of a race against time. Are they going to run out of money when they're spending all of this money to try to get this stuff out of the ground before they actually do it in a meaningful way and then can sell it? So yeah, I think that's the big concern. Yes, so Rodney is saying, and I know I am terrible at this, I got to figure out what we're going to do about this. He says, but not access to overseas ETFs yet. So yes, Rodney, that is true. We only have Aussie ETFs that trade on Aussie exchanges. But yeah, we will. We're looking at ways that we can hopefully incorporate international ETFs. We have the research. We have teams in the U.S. that research. For example, U.S. ETFs. We're just looking at a way to try to incorporate that. Sorry, I'm answering a question on here. All right, looks like we're out of questions, Will. What do you think? Well, we're close to the end of this, right? So if there are any final questions, please send them through. Oh, here's another one. We're getting lots of questions. All right, the presentation on ETFs talked about a Morningstar Barometer report. Is this available to premium subscribers? It is. What I would do is I'd email me. So what we do is we do a market barometer report that basically looks at investor returns versus investment returns. Oh, that's actually Mind the Gap. Different report. Market barometer report. We are looking at how active funds and ETFs perform versus passive funds and ETFs, and we're looking at different asset allocation buckets. So small cap stocks, for example, fixed income. So we do have that report. I would say send me an email. I'll put my email into this, but it's mark.lamonica1@morningstar.com. And I will get you that report. Cool. All right. I think we are there, Will. We did it. All right. Will's excited that he gets some time off away from me. And I don't know what I'm excited about. But anyway, I'll be back a week from today. I will put through a new list of different topics we'll cover in the upcoming webinar. So we'll do some new stuff and do some, classics. If anyone has any suggestions, oh, now we're getting more questions. This always happens. If anyone has any suggestions, I'll just say this. Please send them to that mark.lamonica1@morningstar.com. If there's anything you want us to cover, I will get those. All right, so Edward has a question. So Edward said, why do different analysts value the fair value of a stock differently? Yeah, pretty simple. So analysts are generally using the same that spreadsheet that I show, like the way that you discount things back, yeah, analysts are typically using the same thing, but all of their inputs are different. So that is sort of the art of valuing something. So if I change those inputs significantly, yeah, there'll be very big differences in what the valuation is. So if I go back to, we'll just pick a company. So we're in the UK. Hey, AstraZeneca. It's been in the news. We'll look at AstraZeneca. So basically, and I don't know, Damien, I don't know our UK team. So basically what you can do is you can go in and look at fair value and profit drivers. So it's a piece of the report. That's where our analysts describe at a high level what are their different assumptions that are going in there. So that's where we get to see why they think something should be valued in a certain way. So, we've done this, and I've been pretty critical about some of the valuations in the market around buy now, pay later companies, but all of those are justified by people's estimates of what's going to happen in the future. The question is, will that actually happen? So when you're looking at what different analysts are valuing shares at, you need to sort of talk to them, at least at a high level, about what are the inputs. So if somebody sits there and says, 50% of Australians are use Afterpay 4 times a week, yeah, that can be their justification for what's going in there, where if our analyst says, no, we don't think it's going to grow that fast, that's their justification. So it's really you trying to figure out which of those inputs make sense and make sense to you. So that's when you're looking at webinars. I'm losing my mind. That's when you're looking at different fair values. Okay, so anonymous attendee said, are past webinars available on the website? They are available on the website. So I will share this again. Well, I got to say that I'm getting very good at sharing the screen. All right, so let's go to, we're going to learn to invest. And then don't worry, Will, you know where I'm going to go after this. Your pride and joy. Morningstar Investing Bootcamp. So basically, here are all the ones. Will basically captures screenshots of me where I look ridiculous, and then he puts them all with my mouth open. It's like you have some sort of software that just finds my mouth open, and then Will puts those on there. But they're available there, and you can go back and look at the other ones. Or if you go to our friends at Google and you say YouTube, this is Will's pride and joy. Am I explaining? Am I hyping this up a little too much? So you can go to our YouTube channel. Will swears that people watch YouTube. So you can go on here and see this. If you go to playlists, here we go, Investing Bootcamp. So what we've done is we've started posting everything on here. So you can go and read these. So see, on the 18th of February, I did the same one, how to value a share. So you can go compare whatever I said, see if it's consistent. So basically you've got all these things on here. So we started adding them to YouTube. Will has to press this button on his camera. Did you do that today? I didn't remind you to do it today. All right, Will's having a hell of a day. So you can go on and view those there as well. All right. Okay, well, thank you guys very much. I appreciate it. Any questions, please email me, mark.lamonica1@morningstar.com, and I'll see you guys in a week.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.